I've made this analogy before, but it would be awfully hard to build a house if the base layer, meaning the measurements you use, whether that be feet, inches, whatever, metric system, doesn't matter. But if that was constantly changing, and every time you went to measure something, the measurement tool was constantly changing, you'd have a hard time making a structurally sound house. Same thing goes in the economy. If the rules constantly change, the base layer of money is constantly changing the rules, and the regulatory bodies who make those rules constantly change and maybe don't follow them so much when stress comes into the system, it's very hard to make financial calculations into the future. And the financial calculation that you should make, and what everybody does make eventually, is they realize that honest people are turned into suckers, and they need to get close to the money printer. That's where they need to be. Problem is the money printer's running out of juice, meaning the more they print, the less valuable those dollars are. And you probably heard, I want to give a shout out to Nobody Special Finance. He did a great summary on First Republic Bank this morning. I recommend you guys checking that out. But here's the Cliff Notes version. They changed the rules, taxpayers bail it out. The question is this the last bank, right? Are there more banks to fail? The answer is yes. And the theme throughout my channel has been rules don't matter. The money printer comes to the rescue, and eventually that ends. And we're in that time where it ends. And it happens slower than a lot of people realize. It doesn't happen overnight where the dollar just collapses. But the more you trust in the system, the more you think the system will fix it, maybe a new politician or whatnot, and you don't choose to exit the system, buying gold, silver, and Bitcoin, the more that they can pull productivity from you. Because every time they print, they take a little bit of productivity, a little bit of your time by printing money and changing the rules and bailing out banks. Because people are making financial calculations based off the rules they wrote that they change on a moment's notice if necessary. All on the backs of U.S. taxpayers. Keep that in mind. And that will continue in perpetuity. And I'm not surprised, and I won't be surprised as it keeps coming out. But the problem is when the majority of people realize that, it turns into a stampede. I think I've used this analogy before. If you're in a theater and one person runs out, you don't really think much of it. But if 5 people are running out, 6 people are running out, you start to think, oh, what's going on here? And you kind of join the crowd because you start to panic just like everybody else. So you don't want to be in that position to be the last person to run out of the theater. And you got to understand this isn't a bug. It's a feature of the system. They will change the rules to benefit them, and the taxpayers will bail you out if you're a bank. And they know this. So why do I say it's not the last one? Well, Moody's, which is a rating agency, recently downgraded, according to the Wall Street Journal, 11 regional banks, including Zions, U.S. Bank, and Western Alliance. What does that mean? Their creditworthiness, right? So it would be like your credit score going down when Moody's downgrades these banks. They look at their balance sheet and they go, oh, maybe you guys aren't that great. Maybe people shouldn't deposit. Maybe people should have a risk-adjusted return if they're buying bonds from these banks. Reading from the article, Moody's Investor Services downgraded 11 regional lenders Friday, suggesting higher interest rates and recent bank failures has ushered in great instability. So you think it's done with First Republic? No, it's not. The downgrades hit lenders like U.S. Bank Corp, Zion Bank Corp, Bank of Hawaii Corp, Western Alliance Bank, yada, yada, all after First Republic Bank failure. And I asked this question before. We kind of live in a different world where me as a borrower, and a lot of people as a borrower, like some 40% of mortgages were either issued or refinanced, therefore issued, in 2021 at historically low interest rates. So if a bank has that on their balance sheet, they are losing money. If the interest rate is below 3%, maybe below 4%, they are losing money. So who's going to buy it? I don't know. I wouldn't. But unless the government gave me a sweetheart deal, maybe push some cash under the table to me, maybe I would if I was JP Morgan Chase. But that's a huge problem. Again, the massive bet that was made in our economy in 2020 and 2021, and actually the last decade and a half, was that we would never have inflation. So we'll print to our heart's content, and interest rates will never go up because we'll never have inflation, and it'll be great. That was the big bet that was made. All of a sudden, we have inflation. So now there's tons of mortgages out there that yield less than 3% below the rate of inflation. Therefore, banks that hold those mortgages are losing money. So as they continue to lose money, they become, what's the word? Insolvent. Yes. And therefore, they're bailed out by the taxpayer. All right, ratings agencies have said strains in the way banks are managing their assets and liabilities are becoming increasingly evident and are pressuring profitability, also known as solvency. Recent events have called into question whether some banks assume high stability of deposits and their operational nature should be reevaluated, the ratings firm said. Translation, the balance sheet doesn't look too good. So if there was maybe 5% of depositors that wanted their money tomorrow night, you guys couldn't provide it. Further reading, U.S. banks have a relatively low capitalization as well as unrealized losses on its securities, Moody said. On an earnings call last week, executives said that the bank's capital levels fell because of the recent acquisitions, but they expect to rebuild it over the course of this year and next. So people want their money. People are worried. And the more this happens, the more people want to get their money out of the bank, especially large depositors. Further reading, Zion's had significant unrealized losses on its security portfolio, and capital has deteriorated, Moody said. So I won't continue reading. It's just more banking jargon. But if you take anything away from this video, and my point overall is that this is a feature, not a bug. This is the way it's going to be. No politician that you vote in is going to change it. This is the way the fiat money system works. It's going to pull productivity off the back of your labor. It has to. And so if you continue to stay on the train tracks as the train comes down the tracks and you wonder why you get hit, it's kind of dumb in my opinion. I see the train coming. I see that this ain't going to stop, and it's going to continue to run over the middle class and the poor, mostly the middle class, because the government loves the poor because they can pay them to stay poor, right? The middle class, people who aren't so reliant on the government for their day-to-day necessities, government doesn't like them as much. They also like the rich because the rich pay for politicians to get in office. But the poor, dependent on the government, the rich pay for them to get into office. The middle class, we don't like them so much. But it's going to continually crush the middle class, and you guys have seen it. It's harder and harder to afford a house. 2 people have to work where 1 person used to be able to do it to afford a family, yada, yada, yada. And this trend, unfortunately, as disgusting and immoral as it is, will continue. And a lot of people don't realize that it is a feature, not a bug. They think that, oh man, well, emergency, we got to put out the fire. But in all reality, what's going on with First Republic Bank is you, the taxpayer, are bailing them out. And it will continue to happen. If you want more on that, check out Nobody Special Finance. But it will continue to happen with these other banks that are being downgraded as people pull the deposits. Sooner or later, that theater, it's not going to be 1 person running out. It's going to be 6, 7. And as more people run out, the panic ensues, if you get my drift. And what that means is the Federal Reserve has to come in and back every single deposit in the United States. $17 trillion worth. What does that mean for inflation? Goes up. And all this is under the umbrella that we are running up against the debt ceiling. Not good. Not good at all. It's kind of, it's funny from my perspective. It's not funny, the pain that it's going to cause people, but it's funny that politicians continue to write regulations after like '08, they're like, oh, we need to write these regulations to protect and to prevent this kind of thing in the future. And the thing in the future happens again, and they forget about the regulation. They just pretend it doesn't exist. So if the regulation was there to prevent this kind of stupidity, and then they forget about it, what do you think is going to happen? More of the same stupid stuff. All right, guys, let me know what you think in the comments below. Like this video, share this video out. It would be much appreciated. I'll see you on the next one. Peace.